Good evening, friends. I extend a very warm welcome to our esteemed panelists and the various participants who have joined us on virtual mode. This is the third seminar on Second Standard Week, which is being celebrated by ICSI from 18th of April to 24th of April, 22nd of April. Sorry, 24th of April. The theme which has been decided was Decoding Second Standard and Guidance Note issued by the ICSI. On the 18th, we had a general overview of the various second standard as well as the guidance note issued, the importance of these, and then the second day on 19th, we had on SS1 and SS2, which are mandatory, both on board meetings as well as general body meetings. And today we are going to touch upon SS3 and SS4. I would like to, in the same breath, mention the fact that SS3 on dividend and SS4 on board report are now, which is a commitment to you will confirm and reaffirm the fact that it is not voluntary to be adopted by the concerned companies. Friends, we have received an overwhelming response from the professional fraternity, and I'm very happy to share that in inaugural webinar of Second Standard Week, there were around 6,000 viewers on the 18th, and yesterday we had over 8,000 viewers. I'm sure that you will continue to break this record with much active participation in this webinar. In fact, in one of the groups where I'm a member, there were great appreciation for this particular program. And if possible, I said, if it is very encouraging, we may have one more program later in the year, maybe in September, October, depending upon the time frame which is available at the ICSI. The credit goes to our expert panelists who are not only decoding the second standard and guidance note issued by ICSI, but also impressing upon the reaping the benefits of adopting these standards by the corporates and the professionals. Declaration and payment of dividend is an important corporate action for any company, and equally, disclosure and board report showcases the governance framework adopted by the company. Both these topics are very important and relevant from shareholders' perspective. In today's session, our expert panelists are going to deliberate upon these pertinent topics and best practices enshrined in the second standards on dividend and board report. As a moderator of this session, I once again welcome you all and to this webinar. And before we proceed further, I have the pleasure to introduce our expert panelists for this session. Both the panelists, Mr. Narayan Shankar as well as Mr. Ranganathan, have been addressing our members very frequently, and they are well known to all of you. Nevertheless, I take this liberty to introduce them to the audience. Narayan Shankar is an associate member of the Institute of Company Secretaries of India. He holds a bachelor's degree in commerce and a degree in law from the University of Mumbai, and has over 25 years of rich experience in the field of corporate law and legal affairs. My association with Shankar started in the year 89-90 when he was with the Sterlite Group. Mr. Shankar joined Mahindra & Mahindra Limited in the year 2001 and is currently the Executive Vice President and Company Secretary of M&M. He heads the sectoral compliance function for the entire Mahindra Group, and is also a director on the boards of various Mahindra Group of companies. He's a member of the expert group on second standard, and he has been there for a quite long time, and has also been a member of various committees set up by MCA and SEBI, and he was also a member of the second standard board, which was there originally. Mr. Narayan Shankar has played a very influential role in raising the corporate governance standards in M&M to its current level. During his stint at M&M, M&M has twice been honored with Golden Peacock Award for the best corporate governance and best governed company award twice from ICSI as well. He has represented the industry on several occasions with MCA, SEBI, depositories to take up the various issues faced by the industry. We welcome you, Mr. Narayan Shankar. Mr. C.S.B. Ranganathan, another famous acquaintance of mine. Mr. Ranganathan is presently General Counsel, MQ Pharmaceutical Limited. Prior to this stint, he was with Edelweiss Financial Services Limited, and earlier with the Tata Group, I suppose with the Tata Chemicals, I suppose. He is a fellow member of the ICSI, ICMA, and a lawyer. He has 30 years of experience in corporate field encompassing governance, company law, investment, banking, corporate restructuring, NBFC, and allied corporate law matters. Presently, he is member of the expert group on Secretarial Standard of ICSI, and earlier he was a member of the Secretarial Standard Board as well. He was also a member of the Company Law Review Committee constituted by MCA to review the Companies Act 2013. He is a senior faculty with various business schools and a regular speaker in ICSI, ICAI, ICMA, besides being attached to the Industry Association. I welcome you, Mr. Ranganathan. Now, what we intend to do is we will have a session of from Narayan Shankar first, followed by Mr. Ranganathan. Each one specifically discussing on, while Narayan Shankar will concentrate on board report, Mr. Ranganathan will do it on dividend, and then after that we will have questions. Be alert, keep sending your questions on the chat box, and we will have time as far as, because there are only 2 speakers, unlike the other programs where we had 3 speakers. So we should have enough time for answering all your questions. Over to you, Shankar.
Shankar, you are mute. Please unmute.
Welcome, friends. Today we are going to speak on SS3 and SS4. I'm going to start with SS4, which is Secretarial Standard on Board's Report and Guidance Note, and my colleague Ranga will thereafter take up SS3. Are you able to see the presentation in proper presentation mode?
Not, Shankar.
Hey, this is the one.
Whatever. It is the one now which is coming. It is.
Yeah, correct.
It's come. Okay. Thank you. So we are going to start with the board's report. As you're aware, friends, the board's report is an important means of communication by the board of directors of a company with its stakeholders. It provides the stakeholders with both financial and non-financial information about the company and its performance. And it should relate to the financial year for which such financial statement is prepared. Okay. But more importantly, it is a repository of information, both financial, non-financial. It includes performance and prospects of the company, relevant changes in the management, changes in capital structure, recommendation as to distribution of profits, future and ongoing programs of expansion, modernization, diversification, capitalization of reserves, issue of capital, relevant info, and many relevant information. What is the laws governing the board's report? Friends, it is the Companies Act, SEBI LODR. You have other laws like RBI, IRDA, POSH, specific regulations applicable to an industry and so on. And of course, we have from the Institute SS4, which was effective 1st October 2018, and Guidance Note on SS4, which was again effective from May 2019. While Narasimhan alluded that we are on the SS week, as you're aware, Secretarial Standard is, I think, one of the most unique and pioneering steps taken by your institute towards standardization of diverse secretarial practices. Guidance Note, on the other hand, friends, is practical aspect. We can say, while it is, people call it procedural, but I will say getting entire practical aspects into the Guidance Note. It gives humongous amounts of illustration. It gives FAQs. It incorporates replies to various queries raised by stakeholders on the SS. Okay. In fact, the number of questions which have come on board's report, or we have been deliberating over a period of time, is humongous. For example, we were discussing on signing of report. As you're aware, financial statements, once approved by the board, are signed on behalf of the board and then submitted to the auditor for their report. Thereafter, the financial statement is signed by the auditor, and then the audit report is thereon submitted to the shareholders. The number of queries which came up for discussion: what if auditor is available, and what if auditor is not available on the board meeting day? If he is available on the day, how is financial statements and board reports to be dated? If auditor's report is probably dated after the date of approval of the financial statement, what happens to the board report? A second point which came up was the audit committee recommendations of the board. As you're aware, where the board has not accepted any recommendation of any committee of the board, which is mandatorily required in this relevant financial year, the same needs to be disclosed along with the reasons thereof. Which recommendations or submission by the committee is required for approval of the board of directors for this disclosure? Is it all or only some? Similarly, when we talk about AOC, there is a requirement of details of certain contracts and arrangements or transactions at arm's length and not at arm's length also. What is the interpretation of the word certain coming in the heading of AOC 2, where it talks of arm's length? How do you interpret? This is just what I can say, giving you a glimpse of the number of deliberation, number of discussions which happens at the SSC, or now called core group. And believe me, friends, there is ample guidance given in every aspect on each issue concerning the CS professionals. What is the process we follow at ICSI? In fact, for the guidance note, questions are received at ICSI, questions are received by many of our members, fellow members. It is received at various WhatsApp groups. All are just dumped by us to the Secretariat. Rakesh, who's the backbone of our Secretarial Standard Committee, as well as the core group. The Secretariat, headed by Rakesh, collates each and everything which is dumped to them in a very unstructured manner. Okay, and he then collates us with the requirement of the law. This is deliberated, debated with the best of minds, and then collated with examples. We apply doctrine of interpretation, and what then comes out of this kitchen of core group is served in a platter called whether it is standards or guidance note. Is the so-called what I can just say, while I was the convener for the board report as well as for the guidance note, I will be failing in my duty if I do not start with paying my gratitude to each and every one who has contributed, whether in terms of the earlier committee or even now, whether it was GP Madan, Savitri, my colleague Sudhakar, Geetika, Ranga, who's a panelist over here, Makaran Joshi, Kali, and many, many others who have put in their best efforts to bring out such a wonderful masterpiece called SS4 and Guidance Note and SS4. Friends, I can go on and on, but as you're aware, my colleague Narsimhan will not be all that gracious to allow me when it comes to the end of 45 minutes, and hence I need to rush to the topic on hand. As you're aware, for board's report, when we are talking about annual report, this is really the annual report period for all our corporate professionals, whether it will become bifurcated into board's reports, management discussion and analysis, BRR, which is now BRSR, CG report, as well as the notice. Okay. Now, what is the various contents which are currently there as part of the SS is there in front of you in the slide, but I don't want to waste time repeating every part of it. I would rather right now get into value add to say what are those additions, what are the amendments which have made, which is going to be effective from 21-22, which professionals have to go through and do it as part of their board report in this board report. Okay, the very first which comes to my mind is, of course, impact assessment for CSR projects. As you're aware, as per Rule 83A, which is in front of you, if you have an average CSR obligation of 10 crore or more in the last 3 financial year, and if you have a project outlay of more than 1 crore, and if it has been completed not less than 1 year before undertaking the impact study, then you will have to undertake an impact assessment. What is important for this particular, while there is a separate module on CSR over the week, however, what is important for today is a Rule 83B, which says that the impact assessment reports will have to be placed before the board, and it will then be annexed to the annual report on CSR, which is an annexure to your board report. Okay. As you're aware, under 83C, you can book expenditure not exceeding 5% of 550 lakhs, whichever is less, which is over and above the administrative expenditure which you can do. So, in terms of the format, you need to be extremely careful. If you go through the annexure 2, which is format for the annual report and CSR activities to be included in the board's report, you have to, if you go to clause number 4, it will require you to provide details of impact assessment of CSR projects carried out. And in terms of Rule 80, Clause 80 of Annexure 2, the amount spent on impact assessment is also required to be given. Many questions comes when you talk about details of impact assessment. In the earlier slide, we just saw that under the provisions of 8.3, what is the requirement? The requirement is that you have to do impact assessment if you have completed a period of at least not less than 1 year before undertaking the impact study. So the question which comes out, whether impact assessment needs to be compulsorily done for 21-22, this is a question asked by many of our colleagues. And all the subsequent years, can a company prescribe the frequency at which impact assessment can be carried out, and so on and so forth. To answer to it, Rule 8.3, as you're aware of CSR rules, is silent about the maximum timeline within which impact assessment is to be done by companies for such completed projects. And it also does not say that assessment is to be done in the immediate next financial year in which the project gets completed. Besides this, if you see, the timeline within which CSR projects will have its impact will vary from project to project. Rule 8.3 of CSR rules prescribes 1 year as a minimum benchmark post completion of project, after which impact assessment should be done for that project. However, for some projects, a longer post completion period may be needed for the impact assessment. Hence, it is the responsibility of the company to get the impact assessment done within a reasonable time period of time, considering the nature of a project. It is recommended that a company may prescribe a frequency at the CSR committee and the board at which, that is the frequency at which impact assessment will have to be carried out for the completed projects. The timeline for impact assessment may vary from project to project. We said for some projects it could be 1 year, it could be more for other. But the key, if you want to shift and if you want to really answer the question, is it really compulsory? I've completed 1 year of the project post 22nd January of last year. 1 year is complete this year in Jan 22. Is it compulsory for me to do impact assessment in this year itself and disclose it in the board report? Answer appears to be it will be discretionary for the company. Impact assessment has to be done, friends, project wise and not financial year wise. The only requirement, as I said, impact assessment report, if you do for the current year, please place it before the board, annex it to the annual report on CSR. If you see the last line, we say is that amount which is spent on the CSR will also come as part of the impact assessment. You can earmark an amount. So the second question which comes, if a company has done an impact assessment voluntarily, where the cost incurred in the same will qualify as CSR expenditure. The provisions regarding impact assessment given, we just saw it in 8.3a, b and c, have to be read, friends, together harmoniously. And therefore, if impact assessment is done voluntarily, the cost of the same will not qualify towards CSR expenditure. And hence, that will not come as part of the disclosure also in the board report. Whether the third question is, when you're talking about details of impact assessment to be given in the board report, whether all projects, there is a provision for ongoing projects, whether impact assessment even needs to be done for an ongoing project which crosses the threshold. Friends, this is also very nicely put even in the guidance note on CSR, which can be read together with the board report. We have clearly clarified impact assessment is required to be done only after the project is completed. If the project is ongoing, friends, and the very fact that it is ongoing, it means it is yet to be completed. You have an ongoing project which you can do it within a period of 3 years, excluding the current financial year. And if it is ongoing, if it is not completed, even if the outlay has exceeded 1 crore, impact assessment is not mandatory. Next question comes, whether impact assessment reports sometimes will go into hundreds and thousands of pages if you have multiple projects. If everything required to be Annexed. It's there in front of the screen also. It has been clarified by MCA that the web link to the access the complete impact assessment reports and providing that executive summary is enough. And if you give a web link of that is enough. You don't have to give the entire report. You can merely upload it and give the web link and probably give an executive summary of the impact assessment in your board report. Okay. Now we shift from impact assessment to the next point, which is also very relevant for the current year. That is disclosure of ongoing projects in CSR in board's report. As you're aware, under 135, just broadly, what is ongoing project? As you're aware, an ongoing project means a multi-year project undertaken by a company in fulfillment of a CSR obligation, and it will have timelines not exceeding 3 years, excluding the financial year in which it was commenced. And if you have an ongoing project, then 135(6) gives you an option to say that if there are unspent amount towards this, you can transfer it to an unspent account within 30 days from the end of the financial year to a special account which is to be opened within 30 days and also transferred. And if you are not able to spend it within the stipulated time of 3 years, then you will have to transfer it to a fund in Schedule 7 within a period of 30 days from the completion of the third financial year. Okay. Now, if you are now in the revised CARO 2020, which applies from this year, there is a specific mention even to be made by the auditors to say whether the company has transferred unspent amount to a fund specified in Schedule 7, whether you have transferred ongoing projects amounts to a special account in compliance with the provisions of 135(6), whether disclosures in terms of ongoing projects have been made in the board report. So hence it is very important that you do all the disclosures specifically. And if you have to take 1 or 2 examples of how the disclosures of ongoing project will have to be done, let us just take a quick example. Here is an example where amount allocated for the project is 1 crore, amount spent is nil, amount transferred to the unspent within 30th April, I have transferred 1 crore. Is it in full compliance of 135(5)? Answer is 100% yes. Even if the entire, if it is an ongoing project, so long as you would have declared it as an ongoing project by the committee and the board, and you have allocated that funds, it comes within the definition of ongoing project, which we have seen, not exceeding 3 years, excluding the current year, then you are well within and you can go ahead. Of course, how to disclose, we will just come. Next, if the same slide, only thing is your exposure or amount allocated for the project is 1 crore, amount spent is 20 lakhs, and the balance 80 lakhs you transfer. Is this sufficient compliance? Answer again appears to be yes, provided disclosures under 8A of Annexure 2 and 8B of Annexure 2 is given properly. If you can see it in the screen, this disclosure in the board's report involving ongoing CSR projects, CSR amount spent or unspent for the financial year under 8A, you will have to make in the current column, what is the amount spent transferred to the unspent account as per section 135(6), both the amount and date of transfer. Okay. And if the amount is transferred to any fund in Schedule 7, then even again name of the fund, amount, date. This disclosure, friends, is required to be done if the transfer happens before the board meeting approving the board report. If the transfer happens after, then it will go to the next statement, which is 8B, which is part of the details of CSR amount spent against ongoing projects. Amounts which will have, if you see point number 9 over here, amounts transferred to unspent CSR account for the project as per 135(6) is specifically mentioned, including the board mode of implementation. Please ensure that 8A and 8B is properly complied. Full disclosures are made in the board's report coming as part of CARO, and it is important that even if you have done an ongoing project, even if you have transferred it to the proper account, but if you have not disclosed it so, you will not be able to take advantage of that being an ongoing project, and all the efforts which you have taken may go in vain. Please ensure 8A and 8B disclosures are properly given in the board's report. The next point which I wanted to make over here, we've found two important points on CSR coming in the board's report: ongoing project, impact assessment study. The third point which I wanted to touch this for the current is, this is the first year, friends, we will have two new elements coming in our annual report. One is CARO 2020 and the second is revised Schedule 3. Both have implications on the board report. As you're aware, as far as CARO is concerned, MCA issued CARO 2020 applicable for each report issued by auditors under 143 commencing on or after 1st April 2021. In fact, CARO 20 includes several new clauses and has revised certain existing clauses of CARO 2016. New CARO has increased the reporting requirements for auditors and have put greater onus on companies to share information with the auditors and users of the financial statements. If we come, of course, you have the guidance note from the Institute of Chartered Accountants also on CARO 2020, which was released on 1st July. And just last week or last month, they had had another guidance on how interplay of CARO with the revised Schedule 3. As you're aware, even Schedule 3 will be seeing its first launch this year. That is from 1st April 21 to 31st March. And there are many new. As you're aware, it will be bifurcated into Division 1, 2 and 3. Division 1 is applicable for accounting standards, companies which follow accounting standards, 2 for Ind AS, and 3 are for NBFCs, etc. There are many new inclusions in the Schedule 3 which compliance officers would need. At least some of them: disclosure of shareholding of promoters, including their entire movement. Everything will have to be given in Schedule 3. So you all will have to be ready, because this will have to be disclosed. Loans and advances granted to promoters, directors, KMPs and related parties. Relationship with stock-off companies. I know many compliance officers are facing a huge to just get that information regarding stock-off companies. All pending registration of charges of satisfaction with ROC. Compliance with number of layers of companies. As you are aware, you can't have not more than two layers of subsidiaries. Compliance with approved scheme of arrangement. So while CARO and the revised Schedule 3 will have many elements which may not directly impact the company's secretaries, but those which are going to impact the board's report and the compliance officer, I want to take few minutes only on that. One, there is a requirement for change in the engagement letter to the auditor signed off with the company. If you see CARO 2020 read with the ICAI guidance note, that requires the statutory auditor to set out their expectation in the engagement letter signed off with the company vis-a-vis the internal audit report for the period up to the end of the financial year, which the statutory auditor is required to consider prior to finalizing, of course, this audit report, including its IFCO FR report. Compliance officers and company secretaries would need to see if this expectation vis-a-vis internal audit reports is already built in the engagement letter for the auditor. And if it does not, then it would require modification. Second, of course, there are multiple other requirements in CARO, whether it is property, plant and equipment, whether it is maintained, if there is any revaluation of 10% or more. But I will skip that and I will only concentrate on those areas, as I said, which will impact company secretary. One of them, first which comes to my mind, is evergreening. As you're aware, multiple companies getting into issues, whether it is ILFS, CG and many companies where there have been allegation of evergreening of loans. Okay. So what is evergreening of loans, friends? Today, for the first time, there is a definition. We have ICAI guidance note, in fact, defines evergreening as an attempt to mask loan default by giving new loans to help delinquent borrowers repay principal or pay interest on old loans. So what are the checks which will have to be done or which will be done, and you need to be careful if there is any slip up which will have an impact on the board report. If any loans are advanced in the nature of loan granted which has fallen due during the year, if it has been renewed, it has been extended, or fresh loans are granted to settle the overdues of existing loans given to the same party, will come to the light. And mind you, your transactions with your own related party and subsidiaries will also come under this purview. And if you have so, there will be complete specification of amount of such dues, including various other details. The clause on evergreening, which will require some deliberation, is that this clause is not merely restricted to overdue loans, but it will also extend to situation where we've said fresh loans are given closer to the settlement date. This will also include loans falling due on balance sheet date and that are renewed or extended or settled post balance sheet date, but before the date of the audit report. So have an eye on evergreening of loans, which I did make a mention. Next, loans guarantees not prejudicial to the interest of the company. Friends, companies would be required to justify loans and guarantees given are not prejudicial to the interest of the companies. For example, they say loans given at a subsidized rate. And friends, subsidized interest rate does not merely mean restricting this, because a lot of my fellow company secretaries say that I have given it at the prevailing yield of 1, 2, or 1, 3, or 5 or 10-year government security closest to the tenure of the loan. And would that be compliance of saying I have taken care that is not prejudicial? Answer may be no. Merely complying with the GSEC rate is not enough for proving yourself above board. For example, if the creditworthiness of one of your companies which you are giving is not all that great, it may require a higher rate and the company merely gives it at a GSEC rate. It will be questioned, because if that same group company would have to go outside, the loan will not be at the best rate. It would have to be done at a much higher rate. Second question which will come as company secretaries: would loans given to employees at subsidized rate of interest will come under this? If so, what will be the answer? Are you subsidizing loans to employees? Can the auditors today say under Coro 20, it is prejudicial to the interest of the company? Answer, according to my view, is if it is as per the policy and available to all the employees, I don't think it should come within the purview of prejudicial clause at all. But however, suppose if it is only given to one related party or one director and not to all the employees, it will be questioned. Second question, how would you justify giving of loan to a subsidiary company or a related party which are financially weak? The question which will come as company secretaries would really be to how do you document this in your board's minutes or the audit committee minutes. When you're giving away the loan or you're taking approval, please ensure that you document the rationale, purpose of the loan, coupon rate, how is it at arm's length, which committee or a council internally is going to monitor utilization. And auditors always have broadly guided us to say we would only have one benchmark to see this. How would somebody view this transaction 2 years down the line? Would you be able to justify this 2 years down the line in hindsight? If the answer appears to be yes, I think you've done a good documentation. Second, if the holding company gives a corporate guarantee on behalf of a subsidiary and it doesn't charge a commission on it, what we charge interest or a commission on the corporate guarantees, whether it will tantamount to be prejudicial to the holdco, whether it will be treated as prejudicial. Can you say anyway it is consolidated? It could be a wholly owned subsidiary, partially owned subsidiary. These are all questions we need to ponder. Next, diversion of loans. Whether terms loans were applied for the purpose for which loans were obtained. If not, then the amount of loans so diverted and the purpose for which it is used will have to be reported. If you see 2 or 3 major companies which got into limelight where the loans were diverted to some other company, the key point which they said is they had taken those loans for what they call, quote unquote, I think it is called a general purpose loan, general purpose term loan. And when it comes under this quote unquote general purpose term loan, the general impression is that then end use need not be or would not be questioned. But friends, even general purpose loans today will be evaluated from the perspective of diversion of funds. So even if a general corporate purpose loans you have taken, how have you used it? Is it used for making investment in subsidiaries? Would that tantamount to diversion of funds? It will have huge impact on your board report. Please be mindful and careful because we are during a board report season. Next, short-term funds used for long-term purposes. You need to say whether funds raised on short-term basis have been utilized for long-term purpose. If yes, the nature and amount to be have to be indicated. Auditors would review balance sheet, cash flow, current ratio. In fact, if the current ratio is less than 1, it is a clear indication that short-term funds have been utilized for long-term. And if you ask the inverse question to the auditors, you say that, okay, I will ensure that the current ratio as of 31st March is more than 1. Would you give me a clean sheet that I have not diverted short-term to long-term? Answer again, as you're aware, the auditors will always have the last word. They will say, do not overgeneralize this because the current ratio may be more than 1 at the end of the year. But as an auditor, they will have to see movement of funds all through the year and not merely on the balance sheet date. And friends, this is one thing I've seen coming all through. Shift from merely looking at positions only at the balance sheet date and gear up to have a more wider check. The next, of course, I don't want to get into what is current ratio, etc. Because and if there is anything, you may definitely raise it in the. I will definitely take it up. Next, as you're aware, if loans and investments are given where repayment of principal and interest has been stipulated, or the schedule has not been stipulated, or if you have given loans and advances to related parties or your promoters which are repayable on demand or without specifying any terms or period of repayment, those will need to be reported. Funds which are borrowed for obligations of subsidiary. This is again a new one. If the company has taken any funds from any entity or person on account of or for meeting obligations of subsidiaries, associate, joint ventures, classic coming straight from the kitchen of ILFS, as you're aware, it's in public domain, where a lot of loans were taken, and finally the loans were all probably diverted to some related parties. So if you have borrowed fund to meet obligations of subsidiaries, the auditor would need to consider, they will even consider whether new loans or advances given during the year, meeting the obligations of subsidiaries. You will have to, even money is fungible. If you have just done a borrowing and your next loans to your subsidiaries probably is matching, you need to be careful. You'll have to have clear documentation of how do you divorce both these documents. Loans raised on the pledge of shares or securities which you are. Loans during the year which is on pledge of securities held in subsidiaries, joint ventures, associates will all come under the purview. As you're aware, under the takeover regulations, a negative lien also comes within the purview of encumbrance. But for this particular clause, friends, negative lien does not and will not tantamount to pledge. The whole purpose of raising these issues today is to you that this is the period where you're going to do your board's report, your annual report. This is just a value add. We just want to say the extent at which we discuss at the SSC as well as at the Kroll group and how every concern of our CS professionals are how we take it into consideration and try to give it in a platter to you. Let's move. The next disclosure pertains to application made under any proceedings under the IBC code and what is the status at the end of the financial year, and if there is a difference between the amount of valuation then at the time of one-time settlement and the valuation then while taking loan from balance, the reasons will have to be given. This is a new requirement, hence I'm just making it a point to mention this so that you do not miss this out. Next, as you're aware, SEBI has omitted the mandatory provisions under Regulation 17(1)(b) for separating the role of chairman and SEBI, and the same has now been made as part of the discretionary requirement. Hence, when you're making mention of the discretionary requirements, please ensure that this particular point is also taken care of when you're disclosing it as part of CG or the board report. Next, will come for the Risk Management Committee. This is again coming out of Schedule 5. Brief description of the terms of reference, composition, name of members and chairperson, meeting and attendance during the year will have to be mentioned. Next, coming from the SBB regulations which have come during the course of the year, additional information which will be given to the shareholders is period of lock-in and terms and conditions of buyback, if any, of the specified securities covered under the regulation. There are a further requirement under Schedule 5 pertaining to loans and advances. So disclosure of all loans and advances by the company and its subsidiaries to firm companies in which directors are interested would have to be given under Schedule 5. The next is related party transactions. As you're aware, the entire related party regime has changed. Besides related party, there is a masked related party or deemed related party, which we call under 21ZC of the definition, which even if the subsidiary has a transaction with another subsidiary or another related party of the subsidiary, or a subsidiary having a related party transaction with a related party of the holding company, everything will now get reported under the wider ambit. I'm sure because of the limit of 10% coming to 1,000 crore as an absolute amount, we will find a lot of companies this time even approaching shareholders for related party transaction. SEBI has been clear and kind enough to give us exemption to say that you can take approval at the very first AGM. But remember, if a transaction relates to any loans, intercorporate deposits, advance, then besides other, you will also have to give details of the source of funds, where any financial indebtedness is incurred to make or give such loans, what is the nature of indebtedness, what is the cost of funds, what is the tenure, and how it is in the best interest of the company will have to be given very clearly. Okay. Even if you have had any valuation or external report which you are relying, please make a mention. Percentage of the counterparty's annual consolidated turnover is also something which is new. And of course, in addition, as you are aware, SEBI circular of 30th March 2022 mentions that if you are providing relevant information so as to enable shareholders to take a view whether the terms and conditions are not unfavorable. Okay. The next one pertains to appointment of people on the board, MD, etc. As you're aware of the change, appointment of a person on the board, if you appoint any person on the board, then you will have to take an approval at the next general meeting or 3 months, whichever is earlier. Hence, we always give guidance to our secretaries. If at all you're a listed entity, you would not want to go for postal ballots or an EGM, please ensure that all these, if possible, all these appointments are bunched up at when you're taking up your AGM and annual report matter, so that you can do it immediately at the AGM within a period of 3 years. There are further disclosures to be made in explanatory statement, but that for the current I will skip. At the beginning, I did make a mention about approval, signing and filing of the board's report. The first point which comes up is, can the board's report be approved through VC? Answer is yes. As you're aware, entire Rule 4 today is omitted, and any of those restricted clause does not apply anymore, and hence even board reports can be approved through a VC. Okay. The next question which comes, can the board's report be approved by a circular resolution? Answer appears to be clearly no. 179(3)(g) provides that approval of board's report shall be done by means of resolutions passed at the meeting. Who shall sign the board report? Now, as you're aware, section 134(6), board's report shall be signed by the chairperson, or if chairperson is not authorized by the board, at least 2 directors, one of whom shall be an MD, and for OPC, 1 director. The next question which we were discussing at the beginning, where I find SS4 giving huge clarity, is that financial statements approved by the board and signed on behalf of the board, we said, are required to be submitted to the auditors for the report. It is only thereafter financial statement will be signed by the auditors. In case the auditor's report or the auditor himself is not available on the date on which financial statement is approved, the report will have to bear the same date as that of the auditor's report. In case auditor's report is dated after the date of approval of financial statements, the report of the board will have to bear a later date when such report is approved by the board. Remember, the board's report will always and should always be dated on or after the date of auditor's report and never on the preceding date. This is the type of guidance we have given even in the GN on SS4. Are all annexures to the board report required to be signed? Yes, annexures to the board report are required to be signed, 134(6), but in the same manner except on CSR activities, which is required to be signed by the CEO or MD or any other director and chairman of the CSR committee. So just, of course, you all are all very clear, but yet, please, there is enough clarity given in the GN, even for signing, even when auditors are available, when auditors are not available, how is an annexure required to be signed, who signs the financial statements, which is also in front of you. So complete detailed deliberations at the committee and core group so that ample guidance is given. Okay, I will skip this slide on financial statements because it is to be signed by chairman or if authorized or by 2 directors, one of them will be MD and CEO. It will also have to be signed by the CFO and secretary. The next question which we deliberated also, how do you sign an annual report in case of a company under insolvency law? To ensure that the corporate debtor remains a going concern, all directors, as you're aware, employees are required to function and assist resolution professionals who manage the affairs of the corporate debtor. Since this ultimate responsibility and power of the board rides with IRP, at least at the core group and at the guidance, we said that let the IRP or the RP approve and sign the board report. The IRP or RP may also direct the directors or officers of the corporate debtor to sign the report and take all necessary actions for compliance of applicable laws. We will now move to RPT and loans and advances. Narasimhan, just give me a hint if I have crossed the 45 minutes, please. At any point.
I need to tell you, kindly stop because it's taking too much of a time. Anyway,
okay, I was
quickly round up because we have Ranganathan also.
That's why. Can I suggest something? No.
Yeah.
So we have to take enough time for FAQs. So what I will do is I will stop here because I was mindful of the time over to you, Narasimhan. And I can take the balance at the Q&A. Thank you.
Fairly exhaustive presentation from Shankar. I don't think anybody needs to go through SS4 now. Everything is portrayed so nicely by Mr. Shankar. Thank you, Mr. Shankar. Thank you. Now I invite Mr. Ranganathan to share his thoughts on SS3.
So good evening, friends. Good evening, friends. Good evening, Narayan and Mr. Narasimhan. Thanks for inviting me to this session, and it's really an exhaustive presentation, Shankar. Many things even whatever it skipped my mind, I think you brought to my attention. Thanks, wonderful one. So we'll discuss offline. So, friends, when we talk about dividend, I think whenever the word dividend comes, most of us, we take it very casually, is what I believe. Let me just tell you that, to what extent we really read the provisions is something which we all have to be careful of, friends. So dividend, we all know it's a return on investment, right? At the same time, what do the shareholders expect every year, especially the listed entities? To put it on a lighter vein, one is on the dividend and the snacks that are being served at the AGM venue, but even gone are those days now. So dividend is one expectation that every shareholder expects at least at the year end from all the companies. Now let me just talk about, it's only a few sections talks about dividend 122 through 123 to 127. Okay, that's one thing. So what is dividend? Now the section dividend, the definition of dividend, section 2 subsection 35 talks about dividend includes interim dividend. Mindful of this fact, this definition, friends. Now let's go to section 123 because I'm straight away getting into the sections for want of time, and how is the structure of this section been made? Let's look at the section, and if we have to declare dividend, what are the 2-3 things we should be mindful of? Okay, one, how is it structured? One, the final dividend, though the Act doesn't use the word final when you talk about dividend, but it uses the word interim dividend. So let's, for the sake of clarity, let's have final dividend and the interim dividend in place. Now, when you talk about final dividend, we all know once the board, the board meeting, when it approves the accounts, that's the time when the final dividend is being recommended by the board for declaration by the shareholders in the ensuing AGM. Now, what are the sources? So please, mindful of this, friends, split that section into two, dissect into two. One is final dividend and what do you call as the interim dividend. Now, if you look at final dividend, the word used is for any financial year. That means it's for the whole year. Whereas in case of an interim dividend, the words that are used is during any financial year. I think these are some of the things which we know, but I would request every one of us, to go through the Act as and when this kind of an act, when this kind of an event takes place, because unlike the other corporate actions where like a buyback or a bonus issue, this is one affair which is almost like an annual affair for almost all the companies. So we need to be mindful of this. So coming back, one is on the final dividend. Now, what are the sources for final dividend? One is on the surplus. That's the accumulated profits that has that you are carried on into the balance sheet. That is one. The second source is profits for the year. First, you look at the profits, and then if it is not, then get into the surplus. These are the two main sources. Then the third source for final dividend is the reserves, free reserves, the accumulated profits that have been retained and transferred to free reserves. That should be used only in case of inadequacy of profits. So for the final dividend, you have three sources. One is the profit for the year, the accumulated profits, a surplus, so-called surplus, and the third one is on the free reserves, which have been the accumulated profits that have been transferred to free reserves. I'm emphasizing this fact, friends. Now let's get into the interim dividend. Now, again, sometime in 2018, there was an amendment to the section, and especially for the interim dividend. So it splits into, again, interim dividend is split into two parts. One is interim dividend. They have added the word. Normally, interim dividend is one between two AGMs that you declare. And we all know that before, whatever dividends that are declared before the finalization of accounts is the the interim dividend. But it has gone to add one more thing, that you can declare dividend even after the close of the interim dividend, even after the close of the financial year, up to the date of the AGM. So that is one thing which has been added pursuant to the 2018 Act to amendment. Now, what are the sources? Now, this is what is interesting. So, unlike a final dividend, I think we all have to be careful about the interim dividend, friends. Now, what are the sources? Now, as I said, if the interim dividend, since you can pay up to the AGM, one, you can use the surplus for the surplus which is available, that is the accumulated profits. The second is the profits for the year that is already gone by, that you can use. But I'll tell you, after AGM, this is where we need to be mindful of. One, again, the surplus could be used. But more than the surplus, when you are declaring interim dividend after the AGM, because it is during any financial year, the first and foremost thing that we need to be careful of or mindful of the fact is that it's profit until the last quarter preceding the date in which you declare interim dividend. I think this is the first factor that you need to consider, friends. And in case you had incurred loss till the end of the quarter, end of the previous quarter, then the only restriction under the proviso is on the rate of dividend that you can declare as an interim dividend. Okay, now the question is, can I use the free reserves that has already been, where the accumulated profits has been transferred to free reserves? Friends, unlike the final dividend where I can dip into those free reserves, I cannot use those free reserves for the purpose of declaring interim dividend. I think this is one thing which we should be mindful of. I think most of us would have gone through it, but this is one word of caution that I would really, request all of us, to be mindful of this fact, especially when you declare interim dividend, friends. Okay, that's one thing which I really wanted to point out in case of how this 123 should be dissected and seen. Final dividend and the interim dividend. An interim dividend has two subsects. Again, any interim dividend that is declared after the financial year closure and till the AGM, and one which is after the AGM which you do. Now, when you analyze these things, some of the things that come to my mind is that for example, if you approve if you finalize the accounts and if the board approves, say on May 15th of a year, and if you want to declare interim dividend, post that, how do you declare? Now, these are some of the tricky things that we should be mindful of this fact, friends. Since I said interim dividend, you need to calculate the profits up to the end of the quarter preceding the date in which you declare dividend. So here in Q1, looks like impossible to determine because March 31st I have already counted for the purpose of final dividend and I had taken it into my to the financial statements. So how do I declare? So this is, anyone declaring interim dividend during Q1, please be mindful of this fact. So that is one thing which I just wanted to share, friends. The second one, if you talk about dividend policies, Regulation 43 of LODR talks about dividend policy. Why only LODR? The ICDR, any company that is likely to come out with IPO when it is preparing a DRHP, also the ICDR also talks about dividend policy and the dividends. The past dividend history needs to be mentioned. Now, dividend policy is one thing which, whether it is really applicable in an Indian context or not is another debatable thing. But in my view, when you talk about dividend policy, we all know, friends, dividend is nothing but, it's a return on investment. Some of the Latin countries, like Brazil or Chile and Colombia, those kind of Latin American countries, there is a concept called mandatory, dividend or a compulsory dividend that any company that is in the listed space have to declare dividend. So the government expects that more and more, the moment you earn profits, there has to be, the shareholders have to be benefited. So whether that kind of a concept could be employed in India, the answer is no, because the Act doesn't permit, and moreover, it will defeat the principle of declaring dividend. Okay, now when you look at dividend, there are only two approaches, friends. One is the Walter approach and the other is the Gordon growth model. When you read the financial, models, you will understand this Walter approach and the very simple to state, friends. One is even in the director's report, when we say that what is the amount of reserves that has been transferred, or if not, the reason what we give. So it's similar to that. The board has to consider, do I have to retain the retained earnings and also transfer some of the current year's profits to the retained earnings? Now, how the board would determine is basically if the returns or the IRR, what we call in financial parlance, if the IRR from those retained earnings is more than the cost of equity, then it's better to keep it as a retained earning and distribute only a little bit of dividend. This is one theory or the one approach. The second theory or the approach is the Gordon growth model. And it's very simple. Most of the investors like you and me and everybody expects that, dividend is something which I can expect every year, but I cannot guarantee the growth. Though we all say that equity instrument is the most value creating instrument, but at the same time, there is no guarantee that there will be a great growth. So this model talks about a very simple funda where it talks about please distribute whatever is possible during the current year as dividend. So these are the two models that when you think of a dividend. Why I'm saying this is when you draft a dividend policy, we are all, one, you capture no doubt the legal provisions that are required to be captured. But what are the different factors that really are required to be, factored when you formulate a dividend policy? We all know the earnings that a company could earn, or the impending capital expenditure proposal that you have, or if there is any contractual obligations under any agreement that are required to be done. Of course, the legal, the act itself talks about the depreciation and previous year's laws and other things that needs to be factored very, very clearly, friends. Okay, but I'm sure, friends, I think including me, I'm saying most of us, when we talk about dividend and we talk about, very rarely we get into table F and see what is there in, or table A of the 56 Act and see what is it talking about dividend. Everybody, we all know that if a shareholder has to pay some money towards the shares and it could be adjusted against the dividend that is eligible. But there is something very interesting thing which is called the equalizing dividend. Now, what is equalizing dividend? This is one of the factors, again, some of the companies might be considering. It's nothing but when you have a dividend policy, when you say that these are all the different dividend schedule that I'm likely to, follow in my future years. Say, for example, you have a final dividend at the time of approval of accounts. The second one is interim dividend. When do you normally declare? Most of the companies, if you see, they declare in January, the Q3, Assuming that you want to change this pattern or the dividend schedule. From February, you want to bring it, or from the Q3, you bring it down to say Q2, and you don't declare in a particular year. So you defer that. So the expectation is if the investors would have lost by virtue of the shifting to the other new schedule, then they are being paid one time, what you call the dividend, you may call it as a special dividend, or this also, there is this concept called equalization, which, the table F talks about equalization of dividend. Of course, gone are those days when we had this dividend balancing also, when you adjust the export, when a foreign guy needs to pay you something and you pay dividend against that, you can adjust it, which is, of course, no more it's applicable. But the equalization is also one of the factors that you need to determine when you have the dividend policy that is required to be made. So I think, please, friends, also be mindful of regulation 80 to 88 of the table F whenever we do a dividend. I think hardly it will take 5 minutes for all of us to understand what is there in. So a word of caution. Another small, I've seen some of the companies, passing circular resolutions for a declaration of dividend. Let it be a closely held company. But the concept of dividend is that something that is required to be discussed by the board, and hence please desist from using a circular resolution for payment of for declaring dividend. That is one thing which I really wanted to Then the second or the other couple of things, then I will close it, Mr. Narasimhan. So a couple of things which we normally come across is whether the interim dividend should be confirmed by the shareholders at the AGM. My answer is, I think my view is because it's already been declared, there is nothing called confirmation. The Act also doesn't say, because even 102 or the earlier 173 also talks about declaration of dividend. So only the preference, what do you call as, there is no need to confirm the interim dividend because the entire process has already been taken care of by the board itself. That's another thing. Then the one more thing is on preference dividend. Should the board declare preference dividend, or is it, since it is governed by the terms and conditions of the issue of preference shares, whether there is no need to declare, but I think board has to declare preference dividend is, please mindful of this fact. Then one more very interesting thing that comes up is, I need to open a bank account within 5 days from the date of declaration, right? Now, some of the companies, where, especially when you have this holding subsidiary companies, the question that arises, should I open a separate bank account because I'll transfer it immediately? But friends, when the Act is mandating certain things, I think it is better to follow that rather than taking a call. So that's again one of the things which I just wanted to point out. And the, last or the penultimate one is on the when a company, whenever it is in default of deposits or debentures and other things, of course, the Act itself doesn't allow you to pay it. But in case if there has been a default in payment of dividend that has been declared in the past years, whether should I consider even paying dividend, declaring dividend the current year? The answer is no, because more than anything else, if you follow the more than the law, if you really follow the governance principles, I think first you set right those defaults that have happened and then try to declare the dividend. I think dividend is something which, friends, broadly, this is what I wanted to talk, because for want of time also we can slightly, one more thing is, on the accounting side, if you see, gone are those days where we show it below the P&L, where it is by way of an appropriation, where we show it as a proposed dividend and the interim dividend that have been already been declared, but now it is all forming part of your other equity reserves, basically under the reserves, and also as a notes to this. That's a change that we should be careful of. So I think broadly this is what dividend is, not much, it's but at the same time, the standards also talks about certain good practices that which every one of us should follow. A lot of debate was also had gone into it, and based on which the standards have come in. And so, Mr. Narasimhan, this is what broadly I wanted to take. I can take the questions and we can deliberate during the question and answer session, Mr. Narasimhan. Broadly, this is what I want to talk on dividend.
Thank you, Ranga. That's a wonderful exposition of dividend as per the provisions of the Companies Act. Okay, that's great. I have only one thing to say now. Mr. Narayan Shankar wanted to, I felt he should, that's very important, on RPT vis-a-vis the board report. I think we will just take a quick round of response from Mr. Shankar on this particular topic before I take on to the questions. Over to you, Shankar. Are you there?
Yeah, there. Thank you. And thank you, Ranga, for a short presentation. I'm able to get a spillover of your time. Thank you.
No problem. Good. This is more important. RPT is more important, Shankar.
Thank you. Just let me, where is this again? You're able to see it in full screen, please? The presentation? Yeah. Thank you. So the first point on loans and advances and related party, which comes, friends, let me continue from where we had stopped a little while back. What are the details of loans given, guarantees given, and investments made is required to be given in the board report, and how we have even clarified it in the guidance note. First, yes, all loans, guarantees given will have to be, and full details of such loans given, guarantees given, and investment made will have to be made. If you see 134.3G, it requires all particulars of loans, guarantees, or investment under 186 to be disclosed in the board report. If you see 186(4) on the other hand, it will require that the purpose of such loans, guarantees, investment will also have to be disclosed in financials in addition to the details of such transactions. The first provision, in fact, to 134(3) states that where disclosures referred to under 134(3) have been included in financial statements, such disclosures shall be referred to instead of being repeated. So that's been the normal stand, that if there is elsewhere, please refer to it. You don't have to repeat the same. Okay, I will skip this. Now, whether related party transactions are required to be disclosed, we said yes, particularly particulars of contracts or arrangements with related parties under section 188(1) in form AOC2 will have to be disclosed in the board report. It's there in 134(3)H and very clearly brought out in our SS4 as well as in the guidance note. Form AOC2, as you're aware, is prescribed under Rule 8.2 of the Company Accounts Rules. 188.2 provides that justification for entering into such contract with a related party shall also be disclosed. Okay, so the key question which comes up under all this, which RPTs are required to be disclosed in Form AOC2? Because what is the heading of Form AOC2? If you see, the heading of Form AOC will ask you to require us to say form of disclosure of particulars of contracts or arrangement entered into by the company with related parties, referred to in 188(1). It uses the word including certain arm's length transaction under the third provision. So the key question is, what does this word including certain arm's length transaction means? As you're aware, Form AOC2 is divided into two portions: details of contracts or arrangements not at arm's length, where you give full details. Then it talks of details of material contracts or arrangement at arm's length. This is again very nicely deciphered at your Secretarial Standard Committee and has come out in the SS4 as well as in the guidance note. And in the guidance note, we have given clear interpretation and guidance that the word certain, which is used in the heading of AOC2, read with point 2, which you are able to see it above, will have to be interpreted to mean disclosure of only those transactions which are at an arm's length basis if they breach the threshold limits which are material as stated in AOC2. So how is the word certain? First, it should be interpreted if disclosure of transactions which are beyond thresholds which are material. So then the question second will come when you're talking about material. What does the term material means? The term material, again, this was again debated, and here again we've given very nice interpretations and guidance. The term material will apply differently to listed and unlisted companies, friends. For listed companies, they shall apply the threshold of 10% of the material RPTs and 5%, as you're aware, for brand royalty RPTs under 23. Of course, from 1st April 2022, the threshold of 10% or 1,000 crores, whichever is less, under Regulation 23. So if this is the definition of materiality, then this is something which the listed entities will have to take care. When you are talking about those transactions breaching the thresholds which are material. For unlisted companies, what do they do? As you're aware, for unlisted companies, they have now gone to complete percentage terms from absolute amount terms. As you're aware, you'll have reference to Rule 15.3 of the Companies Meetings of Board and Powers of Board Rules 2014. And there will be various thresholds which are given for each of the items mentioned under 188(1) A to G, whether it is goods, services, immovable property, office of profit. If it crosses those materiality threshold, it will be termed material. But for reporting requirement under 1 and 2, which is there in front of the screen, in Form AOC2 it will be only with respect to contract or arrangements provided under 188(1). Hence the material will have same meaning for both listed and unlisted. While you can have different yardstick, but we have further given guidance that if you see it from the view of 1 and 2, it will be restricted to 188(1) only. Okay. Now we go to what additional RPT disclosures are required to be disclosed by listed entities. As you're aware, all RPT transaction will require prior approval of audit committee. And the key difference which have now come with effect from 1st Jan 2022 is only those members of the audit committee who are independent directors are allowed to approve related party transactions. A mention of this should also come in the board report. Third point, which I had alluded at the beginning of my session, and that was, what if board has not accepted any recommendation of the audit committee? As you're aware, under 177 subsection 8, in case the board has not accepted any recommendation of the audit committee, the same will have to be disclosed along with the reasons thereof. In 134.2 again there is a mention as part of the board's report under 134.3 that there will have to be a disclosure of the composition of the audit committee. Here again there is emphasis that if the board has not accepted any recommendation of the audit committee, the same shall be disclosed in such report along with reasons therefore. So again, when we talk about board not having accepted any recommendation of the audit committee, what is the type of recommendations or submissions which are required to be considered by the company secretary? This is again very nicely deciphered and guided in our guidance note. There is complete clarity given, including reason interpretation. You will never find any interpretation coming in a guidance note without following a logic, without giving reasons for that particular doctrine of interpretation. Here again, we have clarified that under 177(8), which provides that the report shall disclose composition of director, audit, and will also have to give disclosures where a recommendation of audit committee has not been accepted. That can be converted into two aspects. That is, in case of listed companies where the board has not accepted any recommendation of the committee of the board, which is mandatorily required in the relevant financial year, the same will be disclosed along with reasons. Now comes the value add from the guidance note, where we have guided that disclosure should only apply where that recommendation or submission by the committee is required for the approval of the board of directors. It should not apply where prior approval of the relevant committee is required for undertaking any transaction under the listing regulations. Of course, as a matter of good corporate governance practice, we had said unlisted companies can voluntarily disclose in the report instances where the board has not accepted any recommendation of any committee, along with the reasons thereof. In fact, we have given complete examples of how and which matter will have to come in the board. So if you see the first portion, if the transaction is in the ordinary course of business or at arm's length and approved by the committee, is there anything of disclosure to be given in the board report? Answer is nil. Let's go to the second. Transaction in OCB and AL, but not approved by the audit committee and referred to the board with a positive recommendation. If board disapproves this transaction, disclosure is required for not accepting the recommendation of the audit committee. So transaction in OCB and AL, approved, not approved by the audit committee, referred with a positive recommendation. So while they are not approving, they are not saying that we are disapproving. It's not approved by the audit committee, but when making a recommendation, they made a positive recommendation. Now let's take a case that they have made a negative recommendation. In this case, it sits at arm's length on OCB, but negative recommendation from the audit committee. Here, a board approves the transaction. Disclosure is required for not accepting the recommendation of the audit committee. And the last example, transaction is again at OCB, arm's length, but not approved and referred to the board without any recommendation. I am not approving the transaction, but I am referring it to the board without any recommendation. So both under 1 and 4, 1, transaction in OCB and AL approved, and number 4, OCB and AL not approved by the audit committee, but referred to the board without any recommendation. In both the cases, we have given guidance to say that no disclosure is required in the board's report. Okay. Then another question which has, as part of this comes, I just wanted to complete subsidiaries also as part, the related party. Is MDA a part of board report, or is it merely an annexure to the board report? As you're aware, in case of companies which have listed, the report shall include MDA either as part of the report or as an annexure to the report. So hence, please be mindful of this. Second, is corporate governance report a part of the board report, or is it merely an annexure to the board report? As you're aware, under SEBI LODR 2015, disclosures with respect to corporate governance is made in the section on the corporate governance of the annual report. There are reference to annual report. Hence, there are divergent practices in respect of CG report. Some companies include CG report as annexure to the board report. Others prefer to include it as a part, separate report altogether, forming part of the annual report. Listed companies, as you're aware, are required to prepare CG as part of 5C. It is advisable that the information already incorporated in any part which have come earlier also should be referred appropriately. However, we have given even illustrations to say that in both cases, it is suggested that a statement on CG report should be included in the board's report. For example, if the report on corporate the report on the CG for the year under review is placed as annexure dash to this report, or you can say this is placed in a separate section forming part of the annual report, and you can give reference to the page number. Listed companies are also required to prepare CG in accordance with Schedule 5. It is advisable that the information already incorporated in any annual report again do not repeat. As part of the related parties, subsidiary companies would come as an important element, and it will come which information of subsidiary should be included in the company's state of affairs. Here again, we have given guidance. Any event or information of a subsidiary will be included if it is material for the listed entity. And how do you decipher this? How is an event of a subsidiary required to be held material for the holding company? Even here, friends, guidance has been given to say if it has any direct or indirect impact on company's reputation. If its omission will result in any discontinuation or alteration of any publicly known event. If its omission is likely to result in significant market reaction if it comes to light at a later date. These are all to be kept in mind to say whether this is an information which is material to the parent listed company. In addition, the board's report should also disclose details of an event or information of a subsidiary if the impact of such an event is 10% or more on the consolidated turnover net worth of the holding company. As part of the subsidiary companies, as you're aware, the listing regulations also define what is material subsidiary, and that is a subsidiary whose income or net worth exceeds 10% of the consolidated income or net worth in the immediately preceding financial year. And in case if you have such a company, two things to be borne in mind, and the guidance note and SS4 further requires what are the disclosures to be given. One, if you dispose of shares in the material subsidiary, resulting in reduction of your shareholding to less than 50, it is less than majority. That has been now changed, or rather I can say corrected. Or you cease exercise of control. Exercise of control could be by various aspects, not only merely beyond of by virtue of a shareholding, by virtue of a shareholders agreement, what is enshrined in the articles of association. If you have got voting rights which are not in tandem with your shareholding, or you have any other veto rights. So if you dispose of your shares to less than majority or cease exercise, you cannot do without the shareholders' approval. We had to, if I have to give an example, we had to dispose of shares in one of our Korean companies, which is a subsidiary in Korea. We had to take approval of the shareholders, make full disclosures, and then only we could go ahead and do the entire process of initiating the sale process. Similarly, if you have a material subsidiary, you cannot sell, dispose, lease any assets amounting to more than 20% of the assets of the material subsidiary during a financial year. And this cannot be done without shareholders' approval. So if I have to give you an example, we have 100 plus subsidiaries, and say one of my material subsidiaries wants to stop a business. Say it's, give an example of say Mahindra Holidays. Club Mahindra wants to say that I will stop or I will dispose of one of my assets, one of my properties belonging to a particular area. If they are hiving off any of that particular thing, that company will have to go through the provisions anyway of 180, where they have to say, does it tantamount to an undertaking? Today there is clear definition of undertaking thresholds given in 181A, and they will seek approval of their shareholders depending on whether it is crossing that threshold of 180. However, if you are a material subsidiary of a listed entity, you have to do one more thing. You have not only to take approval of your shareholders under section 181A, you also have to take approval, what we call piercing the corporate veil, and going above to your parent company if you sell, dispose or lease asset tantamounting to 20% of the assets of your company. So if you're stripping off 20% of the assets, while you can go through 181A, you have to have an additional approval, as the piercing of a corporate veil is more done by judiciary. But this is a very rare example we have given where the legislature itself is piercing veil in terms, and this is rampantly being done now. Even if you see the new related party regime, which we said, even a transaction not concerning two companies will have to come probably to the holding company for approval. So even in this case, if it is a material subsidiary, if you want to strip 20% of your assets, take your approval as well as take approval at the parent level. The next question comes, what are the disclosures which you have to give with regard to such subsidiaries and JV associates? So you will have to give a separate section where report of all the financial position of each of the subsidiaries, associates, joint ventures are included in your report or made reference in your, if there is a reference in the financial statement, what is their contribution to the overall performance of the company. And as we've been telling time and again, that in case if any information is given in AOC1, please make a reference to the AOC1. You need not repeat the entire thing again. Second, even whether it is during the year or at any time, even after the closure of the year, till the date of the board report, if the company has acquired or formed any new subsidiary, please give disclosures. Even where any subsidiaries has ceased to be a subsidiary or account of sale of shares, give full details. Companies which have listed their specified securities will also have to state it in the report. And both these cases, even if you have sold your if you are going below the majority in your material subsidiary, or if the material subsidiary also does any of the stripping of the assets, each and everywhere SS4 has given guidance for ensuring that you make all this disclosures in the board report. But I think that's we should go to the FAQ mode now. I will stop over here.
Yeah.
I just wanted to cover this. Thank you, Narasimhan, for giving me.
Thank you, Shankar. I mean, that's again fairly exhaustive. I mean, one thing I need to be pleased about is today we have more than 7,000 registrations. I have received a whole lot of questions from the chat box through the chat box mode. Let me share those questions first.
Sure.
Shankar, to you. Please, I would prefer a quick, short answer, not a very detailed explanation, so that we can accommodate more questions. We just have about 25 minutes left for the question answers. Please let me know if CFO certificate pursuant to CSR will form part of annual report for the financial year 21-22.
The CFO certificate
will form part pursuant to if the CFO certificate pursuant to CSR will form part of the annual report.
So the CFO certificate you have to give for implementation, that the funds which have been utilized have been actually utilized, and there, even if you see the FAQs given by the MCA, they have clearly given that mere utilization by the company is not enough. You have to take into it from each of the implementing agency, and hence the CFO first should have ample backup, and once the backup is there, he will give it as part of the CSR committee and the board, and necessary disclosures will be given in the board report.
Quick, whether the restructuring of an existing loan will amount to evergreening of loans, and do we need to report that?
So as I said,
restructuring of a loan, it's not restructuring of a loan.
But if you see, Narasimhan, this is exactly what is coming within the purview. So what are they telling? What is evergreening? If you see what had happened in ILFS was, what is the allegation which was made against the auditors as well as the company, including the CFO, etc. What was that? The whole infrastructure industry is not doing well. However, in terms of that particular holding company, I don't think it was the other. The entire group is not doing well, but the holding company quarter on quarter is doing exceedingly well. So hence, what was the question raised? That what is the information? The whole market is aware. It is only the company not aware, the auditor is not aware. Hence, even if you are restructuring it in such a way, because what is the definition of evergreening today? If you are attempting to mask a loan default by giving new loans, if you are restructuring the loan to help a delinquent borrower repay principal or pay interest, and that can be done by many ways, which I had given an example even in my presentation. If it has fallen due, you conveniently renew it, you conveniently extend it or restructure it, and by whatever name. If you have settled it at that due date, it can tantamount to, and it would tantamount to evergreen. Okay. If they have gone to the extent of saying even if it is post the balance sheet date, even there it will get caught. Sorry, go ahead.
Fine, we take over your point. The next question again to you, whether all types of companies should follow the same format of board report?
Undoubtedly, the whole...
Yeah,
undoubtedly the recommendation from SS4, the whole purpose of SS4 and guidance is to have standardized practice. In fact, the next thing which is in the envelope to saying that while we standardize, how can even the sequencing, which the next step which we could take, could also be same in every company. Correct? But SS4 is nothing but standardization of board report.
Okay. A very interesting point has been suggested by one of the participants. As per my point of view, at the time of appointment of Secretarial Auditor, remuneration must be disclosed in the report of the Board of Directors. He says it is necessary. What is your take on that?
There are, I don't want to comment, but there are, while it's more a prerogative of the board, I would certainly say you can disclose it, but currently it is not a must for you to disclose. and neither have we made any recommendation. I don't know whether amounts being disclosed at the board report, whether Narasimhan, from your perspective, whether it would have any other professional issue in terms of undercutting or any other, but subject to that, I have no other comments.
In fact, this is one of the recommendations which a small group constituted.
Yeah, yes.
Has given to SEBI. Let's see how it works.
How it works, yeah, that's why I want to.
Let's see what SEBI does anyway.
Yes.
Whether top 10 employee remuneration is required to be mentioned on board report, since many companies are not giving this data, and whenever shareholders are asking, they are providing them individually. What is the right practice?
So the top 10, if you see, it comes under regulation. If I am not mistaken, it comes in 5. Okay, clause 5, which we call it. Of 1 second, I'll just clause 5. So this is always a question sometimes to say, how do you interpret? Here again, what I'm telling is complete guidance has been given as to how do you do that top 10. Okay, because when you are doing about top 10, is it only restricted to listed entities? Is it listed to unlisted companies, and so on and so forth, correct? So the way guidance has been given, while, if I'm not mistaken, the parent section, 178, does talk of a listed entity. Rule 5.1, on the other hand, talks, if I'm not mistaken, the term used is listed entities. Okay. However, when it comes to 5.2 and 5.3, I think the term used by them is probably the term used is company. So here again, we've given guidance as to how you could harmoniously interpret the main section along with 5.1 and 5.2 and say that so long as you have uploaded in the website, you need not give it, and of course you will give it to all your statutory filing, you need not.
Okay, fine. Now this is a very interesting question, and take your time answering it. Okay, whether an investment done by a wholly owned subsidiary in the domestic foreign entities where the holding company has funded such investment falls under new disclosure requirement of utilization of borrowed funds and share premium under Schedule 3. Do you want me to repeat?
Yeah, please.
Okay.
Whether
an investment done by a wholly owned subsidiary in domestic foreign entities where the holding company has funded such investment falls under the new disclosure requirement of utilization of borrowed funds and share premium under Schedule 3.
But the subsidiary has invested in which company?
Where an investment done by in a domestic or a foreign entity, which is where the holding company has also funded.
So the holding company has also funded, and the subsidiary is also funding the same company.
Correct.
So first it will fall clearly if you are saying it will fall under two clutches. One, if you are going to say that if you are funding or investing a company, the ultimate benefit which is going to come from the next year is going to be a related party. In this case, if you are going to say both the holding company is investing and subsidiary is investing in a same entity, correct?
Yeah.
Would that qualify? The answer was it would get into a related party transaction, because it could be mentioned that both are being done for intersect probably benefit and will require approvals and disclosure.
Thanks. Let me now engage Ranga with some of the questions on dividend. Okay. Yes. These are all live questions. My intention here is at least the participants get the feeling that whatever question they have raised,
absolutely,
they will answer. So that is the reason I am taking only these questions now.
Please.
Ranga, to you. The definition of dividend includes interim dividend. If for the final dividend we can dip into free reserves for declaring dividend, why not the same principle apply for interim dividend? Could you clarify this?
Okay. So basically the change that has come in, if you see that, you can't dip into them, the reserves. Correct. Is in case of a financial year, you know that, it is at the end of the year that you are trying to declare. So you know that you want to declare, maintain the dividend track record that you would have done. And hence, there is a leeway given to enable the company to dip into the reserves. But in case of an interim dividend, there is no hurry. There is no hurry for many company to declare interim dividend. You can wait till the end of the year. I think that could be one of the reasons why the Act is saying that you do not dip into the thing is one of the things.
Good enough, right? Thank you.
Thank you.
This is the question I don't know, despite the fact that you have clarified it so clearly in your address. It says, is it necessary to transfer funds to a separate bank account even if you pay dividend within 5 days of declaration?
Yes, I would say just yes, that's all.
Okay. Can we declare dividend only for preference shares and no dividend for equity shares? Obviously, yes.
Obviously, yes. I don't know why.
In case of dividend declaration by a wholly owned subsidiary to a holding company, is it necessary to open account or distribute it to other nominee shareholders, or we can give dividend straight to holding company itself?
No, you need to open a
Wholly
separate
owned
bank.
subsidiary paying dividend to its
You need to open a separate bank account and paying to the holding company because the nominees are only.
That logic will apply. Opening a separate bank account will apply.
Yes.
What point should be kept in mind while dividend declaration is to a foreign shareholder?
I think for shareholders are treated equally, right? That's the equitable treatment.
Permission from RBI needs to be taken.
RBI, all those things, if it is required, and the process that needs to be followed for remitting the dividend is what you need to do.
Right.
And whatever the disclosures in the director's report.
Can company declare and pay interim dividend on preference shares immediately after allotment of shares?
Interesting question, but at the same time, it all depends on the terms of the issue. But the Act doesn't prohibit any payment.
Dividend will be a fixed dividend for preference shares.
It's a fixed dividend. Preference always it's a fixed dividend. But if the terms, sometimes I had seen, sir, that some of the preference shareholders, they do have some kind of an interim. You can structure it in such a way. So if the terms permit, there is no hard and fast rule of declaring interim dividend immediately after allotment.
Okay. Now this is the company is requesting bank to open a separate account for dividend. However, the bank is insisting on forcing the company to open a dividend account for each financial year. Now, whether that's needed. I open a dividend account, I distribute, all the payment is made. Do I have to close the account?
Yes, I need to close it. For every dividend that is declared, you need to have a separate bank account. It's a simple, logic is also simple. How do you reconcile? For example, if you have large listed company, how do you reconcile the dividend and other things? I think that's the reason you need to have a separate, and banks are correct in saying.
So yes, agree. Completely agree, Ranga. Completely.
Okay, now there is one for Narayan Shankar. Whether information in corporate governance report should be for the respective year or changes till the date of report should also be covered.
While you can cover up to 31st March, but our recommendation would be please cover even those which are up to the date of the report. Okay. Up to the date of the CG report, when the board is approving.
Yeah, very funny and a tricky question. Now, this is for Ranga. In case of remittance of dividend to non-resident, because of a lot of banking documentation, the procedural requirements, the dividend remitted is after 30 days. What are the consequences?
So I think it's very simple. You need to do it within 30 days. So do whatever is possible. Consequences then follow. You need to pay the penal consequences. I think
I've fairly exhausted all the questions, excepting possibly one. Just 1 minute. I have this. Shankar, for you.
Yeah.
Sorry. Yeah. As per law, signatures of directors are required. Whether financial statement, director's report and annexure can be signed by directors digitally by DSC, digital signature. Can they sign it?
So so there are various practices being done, because at least even during COVID, how was thing being done? You have to, if you really say there is provisions even in the Act, and we have given guidance to say that any register or the same which is placed before a board is deemed to have been signed at that meeting at that venue. The same logic you could apply even for the annual accounts as well as for the other documents. Make a mention in the minute very clearly that it is being signed, whatever, digitally or whatever, put it as part of the minutes, and you can go ahead.
Shankar, only difficulty comes in when you sign digitally, the date is also coming on which the signature is affixed.
So that will be an issue, as I said.
That is
but
the only issue.
If you minute, that's why. So that has always been an issue, even for the auditors, where we say that if you are going to sign the auditor's report later on digitally, and they require, what is that number which they require from the institute also, the UIN, whatever that number requires, they also require before signing. And if you digitally sign after, then we also tell them then it is a requirement for me to ensure that the board report is also dated after that date. So there are consequences for when the date comes. Fully agreed, Narasimhan.
Yeah, thank you. Okay, can bonus shares be treated as dividend, Ranga?
No, because see, the concept of dividend is what? A return on investment, right? So it's basically a cash that is coming in and the cash that goes out, an asset is going out of the system. I think bonus shares is nothing but, you pass an entry, you capitalize the profit. So bonus shares, cannot be treated as a dividend. It's completely two different aspects.
There's one question I think I should be answering it. Whether SS3 and SS4 are enforceable, what if someone does not follow it? And let's very clear, it's voluntarily. SS3 and SS4 are not mandatory. Repeat, not mandatory, but you should strictly follow SS1 and SS2. So as long as you follow SS1 and SS2, good enough. SS3, SS4 is just in terms of having some practices which is uniform across board. But if you have any difficulty, ignore, no problem. But nothing will happen to you.
But Narasimhan, since we were speaking about bonus shares and dividend, the general question which comes as part of section 63 is declaration of bonus in lieu of dividend is not permitted. And here, while we have given clear that it will not tantamount, you will have various views emanating in the industry. What do you mean by in lieu of? That means if a bonus share is declared next year, and can I skip dividend? The answer appears to be no. That means there are three views coming in. Should I make absolute quantum of the dividend declared in the previous year? Is it to be maintained? Suppose 100 crores was the dividend outgo in 2021. Then should it be minimum 100 crores to have maintained post bonus, or will I fall in this clutch of in lieu of dividend? The second which I see is rate per share to be maintained. If you have given 100 and post, if it is a 1:1 bonus, even if you give 50, that's enough, because 50 is equal to 100 in the enhanced, correct? Absolutely. And the third view which companies take, a company cannot post bonus skip dividend, and there is no prohibition against reducing the amount of dividend as against the previous year. So we've seen various divergent views happening in the industry.
But one thing, sir, the dividend policy which is adopted by the company may be identifying in these kind of circumstances what
exactly. They will be doing. One second, Narasimhan sir, I just have one thing for Shankar. Shankar, if you look at Regulation 42(3), it talks about, especially on the recorded, dividend stroke cash bonuses. Have you ever interpreted the word cash bonuses which is coming in the LODR? I don't know. I mean, what is cash bonuses? I mean, since you raised about 63 in lieu of, I'm just reminded of this also. It's a foot for thought.
Sorry, Narasimhan. Yeah?
But Narayan, many companies have, of course, declared, they have given debentures instead of dividend. They give dividend or debentures or also preference shares. Over a period of time, they get to redeem it. Ultimately,
absolutely.
That's right.
So it's a manner of, Ranga, it's a manner of how do you enrich shareholders? So instead of giving mere bonus shares, can I give them preference shares? There are companies where they give preference shares and they also have simultaneous arrangement of buying that preference shares where you are cash in, correct? Similar is the case of debenture bonus shares.
Yeah, that's okay. But cash bonuses is something unheard of. Cash bonuses. What do you mean by cash bonuses? Anyway, Narayan will discuss.
So good. So this is our homework which you have given, Ranga, yes, for when we revise the guidance note on SS4.
Yes.
Okay. Shankar, this for you. Should board report be based on group financial statements or standalone company results?
Company results will always, for the board report, will always be standalone, while you will give details of the consolidated financial results and how each subsidiary is doing, which I had made a mention just now as part of what are the things which you are giving to subsidiary, but board report will always be on standalone.
Now one for Ranga. Will SS3 apply in case of distribution of any amount of profits by the company under liquidation?
No, we should understand one thing. A dividend is for a company that's on an going concern basis. When a company performs, a dividend is declared. But liquidation is something where you get only the profits. It's not dividend. Completely, it's two different things.
Okay. Narayan, this again, I'll take you on. How SS3 is promoting good governance when it is reproducing the provisions of the Companies Act, and how it is useful. Now, what Ranga did was the Companies Act toto, but then that is what the SS3 itself. Yes, Narayan.
Okay. So I'm saying, if you see, as I mentioned first, in as a general information, as I said, the amount and the process which I said, which goes into each guidance note and each standards. Okay. And if I have to give some examples of SS3, how with multiple issues we have tackled and say give guidance. Can the company declare dividend if it has failed to redeem debenture, payment of interest on or debentures by a company? As you're aware, 187, company will have to give a debenture redemption reserve for the purpose. The standard prohibits a company to declare dividend if it has subsisting default in debentures. Then default in redemption of preference shares, or if you have defaulted in creation of capital redemption reserve, for example. Even there, the standard goes to prohibit a company to declare any dividend if it has subsisting default in redemption. Non-payment of dividend declared in previous years. Ideally, no dividend should be declared if there is a default in payment of dividend previous years. Correct? Because section 127 deals with penal provisions. No specific restriction is there. Repayment of any term loan to a bank or institution or interest thereon, and if there has been a default, okay, on that. And if there is a subsisting default, which we say, those were also discussed, and we said that in such case we should not allow dividend. Impact of extension of time by any court for what do you call the CDR process, which we say, and if the failure continues, mere extension of time by the tribunal should not condone the act of default. Following the same principles, the standard also prohibits declaring dividend, even if there is extension granted by tribunal or court in many cases. So I thought huge value adds. I'm saying each and every, unfortunately, as I said, amount of discussion, deliberations happen in best of standards and guidance note is available. I can only request our stakeholders, our own professionals, this is for you. Every issue of concern is debated and done. Let our own stakeholders, let our own professionals not start questioning the standards. I don't know whether you can add anything, because ghar ki murgi dal barabar hai. We fully appreciate, but please appreciate the amount of efforts which goes into every guidance note and standard. It's humongous, believe me.
Narayan, there's another interesting question. I've handled this before, and therefore I thought
Sure, go ahead.
If any shareholder of the company is resident of enemy country, how will you pay dividend to him? Normally, in all these cases, the property is held by the custodian of enemy property, and the dividend is paid to the custodian of enemy property. You don't have to worry about it.
Yes.
Ranga, this for you. How to determine true and fair view of financial statements while declaring dividend?
I think true and fair view, I don't think it is exactly defined right. I think you need to go with the accounting principles which talks about conservatism. I think we need to maintain it, and that's how when the auditors are also giving a fair assessment of the financial statements, and that is how we need to go ahead and determine true and fair value, because it's not defined.
Absolutely. Correct, and Narasimhan, generally accepted accounting principles, applicable accounting standards, presented in conformity requirements set out in the Act and applicable laws.
Awesome.
Yeah, good. Shankar, for you, can members at AGM declare dividend if no dividend recommended by the board?
No, this guidance again has been given by us even in the even in the standard that it cannot. That means there is a prerequisite that unless the dividend has been recommended by the board, members in AGM cannot on their own declare dividend. Of course, members have been given only a right to declare a lower rate of dividend than that recommended by the board, but they neither have power to do it suo motu, nor they have power to increase the amount or rate of dividend recommended by the board. And this is coming even in the even in our standard.
Good. Okay, Ranga, for you, can interim dividend be declared only once in a year? What aspects should be looked into by the board to satisfy itself about the amount of dividend being declared by the board?
No, interim.
I think you answered it really well, but anyway, again the question goes on to you.
Okay, the interim, there is no restriction on the number of interim dividends that is required to be paid. The couple of factors that you need to be mindful of, especially the profits at the end of the year, because at the end of the year, if you incur loss and if you had paid dividend, when that is, I think it goes back to saying that Shankar, if you remember 208 of the Companies Act, payment of interest out of capital, so that's one factor. I think major factor that we need to the board has to consider is what is going to be the profits for the year. So long as you maintain profits for the year, I think there is nothing stops you from distributing interim dividend.
Okay, this question for you again, Ranga. The company plans to declare dividend as interim dividend for the first time. How to fix the rate of dividend as no average dividend rate can be ascertained? I think that's based on how much retention of as per the dividend policy only.
Policy of the company, there is nothing. There is nothing to determine.
Narayan, for you, should board's report be based on group financial statement or standalone company results?
We've answered this. Standalone. We've answered. It is coming again.
Frauds report by the auditor, Shankar, to you.
Yeah, go ahead.
Reported by the auditor to central government are not covered under the disclosure requirement of Companies Act 2013, but the same is covered under section SS4. Can specific reason for such inclusion?
So if you see 134.3, which is the prevalent section over here, that requires the details of frauds reported by auditors under 143.12, other than those which are reported to central government. 143.12, as you're aware, gives two thresholds. One, if the value of the fraud is 1 crore and above, then you report it to the central government. If it is below, report it to the audit committee and thereafter report it in the board report, correct? Since disclosure in respect of frauds reported to the central government is also pertinent from stakeholders' perspectives, the standard actually requires that the details of frauds reported to central government be also disclosed. And I thought this is a basic information which the stakeholders would need to know.
Good, thank you. Ranga, for you, why SS3 provides that declaration of dividend should not be passed by resolution in circulation?
No, this is very simple. I mean, dividend is such a thing that, it requires a small deliberation by the board. When a presentation is being made in the board, I think the management also gives different scenarios and the different payouts and the cash outlay that is going to be. And that's the reason it requires a deliberation, and that's why it should be discouraged, the passing of resolution by circulation when you are declaring dividend. I think that's the reason that, you should not do it by circular resolution.
Thank you, Ranga. I think basically we have exhausted most of the questions, all the questions which are received from the participants, definitely, and some of the questions which I had prepared myself. So I think we have exhausted all of them. I think we are bang on time in terms of
Thank you.
This today's program. Almost just about 3 minutes. We started 3 minutes late, and therefore I thought we should close by just 3 minutes after 6. That's what I did. And I would personally thank both of you for sparing your time and sharing your thoughts on SS3 and SS4 with all the participants. I'm sure the participants will be enriched by the words of wisdom spoken by you, and look forward to having you on board again as soon as possible. And I'm sure we'll plan another SS week, maybe in September. And I think we will do great. We will have I think instead of a large presentation, purely question answer session, where we will have a maximum amount of interest generated among the participants as well. Well, I thank you very much, and that comes us to the end of today's program. In fact, we have a program in Mumbai, that is on 23rd, where Mr. Narayan Shankar is also addressing us. We have got, apart from Narayan Shankar, we have Satri Parekh, Geetika Anand, Kalidas Ramaswamy, Pradeep Ramakrishnan, and the chief guest there is Mr. Saravanan from SEBI, Chief General Manager SEBI. Thank you very much. Thanks a lot.
Thank you. Thank you, Nassim. Thank you, Ranga. Thank you.
Thanks, Narayan. Thanks, Mr.
Thank you.
Thanks, Rakesh. Thanks a lot.
Thank you.
Thank you. Thank you, Rakesh. Bye.